Welcome back to Accounting Classroom. In this lecture, we'll explore the first-in, first-out method of material pricing, one of the most common and examinable inventory valuation methods in cost accounting. FIFO means first in, first out. It assumes that the materials received first are the first to be issued for production. In other words, the oldest stock is used up before the newer ones. The FIFO method helps businesses determine the cost of materials issued and the value of closing stock. It's commonly used in industries where materials are perishable or time-sensitive, like food, chemicals, and medicine. Let's visualize it. Imagine boxes of materials stacked in the store. The first boxes purchased are taken out first for production, while the new arrivals remain behind. So, when issuing materials, we charge the oldest cost prices first. Now let's take a practical example. We'll record material receipts and issues using the FIFO method. Follow carefully as we go line by line. Using the FIFO method, calculate the total cost of materials issued and the value of closing stock from the following data. On January 1st, we had an opening balance of 100 units at $5 each. So the balance is 100 units at $5. On January 5th, 60 units were issued. Since the oldest materials are issued first, all 60 came from the opening stock at $5 each. That leaves 40 units at $5 remaining in stock. On January 10th, 200 new units were received at $6 each, so the balance now becomes 40 units at $5 and 200 units at $6. On January 15th, 120 units were issued. Under FIFO, we must issue the oldest units first. That's 40 at $5 and the next 80 at $6. That leaves 120 units at $6 still in stock. On January 20th, another 100 units were received at $7 each. So our final balance becomes 120 units at $6 plus 100 units at $7. Now let's calculate total cost of materials issued. The first issue was 60 times 5 equals 300. The second issue was 40 times 5 plus 80 times 6. That's 200 plus 480, giving 680. So total issue value equals $980. The closing stock value is 120 at $6. That's 720. Plus 100 at $7. That's 700. Total closing stock value, $1,420. So under FIFO, materials issued are charged at the earliest purchase prices, and the closing stock reflects the most recent prices. Advantages of the FIFO method include: 1. It's simple and logical. Old stock goes out first. 2. Closing stock reflects recent prices, so it's close to current market value. 3. It reduces the risk of materials becoming obsolete or spoiled. However, FIFO also has limitations. 1. During inflation, the cost of goods issued is based on old, cheaper prices, making profits appear overstated. 2. Frequent price changes make calculation complex. 3. It may not reflect true replacement cost. FIFO is the opposite of LIFO, last in, first out. FIFO uses the oldest prices first. LIFO uses the newest. In times of rising prices, FIFO gives higher profit and higher closing stock value than LIFO. In summary, FIFO assumes oldest materials are issued first, ensuring stock moves in order of arrival. It's suitable for perishable or time-sensitive goods. If this lecture helped you, please like and share this video. Don't forget to subscribe to this channel. Till next time.